Welcome to this explainer, where we're going to decode the financial and legal machinery driving business growth across Manitoba. Have you ever driven past a massive agricultural operation and just wondered how a local farm affords a multi-million-dollar fleet of advanced tractors? Or maybe you've walked into a brand new medical clinic, marveled at those state-of-the-art MRI machines, and thought, how did they actually buy these without completely draining their bank accounts? The sheer price tags on modern commercial equipment are just staggering. So today, we're literally looking under the hood of commercial financing to see exactly how it works. You're definitely in the right place to uncover the hidden financial levers of growth.
Here's our quick agenda for today. First, fueling Manitoba's business growth. Second, leasing versus buying equipment. Third, the PPSA, protecting lenders. Fourth, priority, who gets paid. Fifth, funding farms and clinics. And lastly, Manitoba government business incentives. Let's dive right in.
Section 1. Fueling Manitoba's business growth, the need for capital.
Think about it for a second. How do you actually plan to fund your next big growth phase? Whether you're looking at a $500,000 combine harvester or a high-tech MRI machine, scaling operations requires serious, heavy-hitting capital. Unless you happen to have a spare $500,000 somehow lost in the couch cushions, you just can't write a check for massive assets out of your daily operating accounts without completely flatlining your cash flow. To grow efficiently, you absolutely need external funding.
Now, you generally face two paths when seeking those crucial funds. You can go the traditional route with banks, which honestly typically takes 1 to 2 weeks, involves super rigid terms, and requires an airtight, highly established financial profile before they'll even look your way. Or you can look to agile commercial finance brokers like FinCap. Because brokers sit on your side of the table and leverage dozens of different lenders all at once, they can often process approvals in under 24 hours. Plus, they offer flexible terms that can actually accommodate startups. It's really all about finding a funding partner that matches the speed and reality of your business.
Moving on to Section 2. Leasing versus buying equipment, choosing your path.
Every business owner faces a fundamental trade-off here, and this perfectly breaks it down. Leasing is kind of your ultimate cash flow protector. Because there's usually a very low upfront payment, or sometimes none at all, you perfectly preserve your working capital. You get to use the asset immediately to generate revenue, but you don't actually own it. A traditional loan, on the other hand, gives you immediate ownership from day one, but it demands a hefty down payment, which ties up your precious cash right at the starting line. Your choice depends entirely on whether your immediate priority is preserving that day-to-day cash or building long-term equity in the physical asset itself. Both are totally valid. Section 3. The PPSA, protecting lenders, the invisible safety net.
Let's pause and flip the perspective for a minute. What gives a lender the ultimate confidence to just hand over the keys to a brand new bulldozer or a whole fleet of transport trucks to a growing business? Well, it turns out there's an invisible safety net making this all possible. The Personal Property Security Act, or PPSA. Established in Manitoba, this massive legal framework acts as a sort of superpower for lenders. It governs almost every secured transaction involving personal property in the province. Quite frankly, without it, modern commercial lending would just simply not work.
The source material perfectly outlines why the PSA even exists, and it's not just boring compliance or bureaucratic red tape. The fundamental aim is to provide rules under which commercial transactions can be concluded with reasonable simplicity and certainty. That word, certainty, is everything. If credit providers couldn't be absolutely certain that their financial interest in a piece of property was legally protected, credit markets would just freeze up entirely. The PSA balances the deep need to protect the lender with the need to let businesses confidently buy, sell, and operate.
To truly understand how this invisible safety net functions, we need to break down its core mechanics. And we'll start with collateral. Collateral is simply the actual, tangible asset that the security interest applies to. Whether it's raw materials, consumer goods sitting on a shelf, or a massive earth-moving excavator, the basic concept remains exactly the same. This is the physical property backing the loan.
Once you have that collateral identified, a process called attachment occurs. Think of attachment as these invisible legal strings suddenly shooting out and securely tying the lender directly to the equipment. It fundamentally means that all the necessary legal events required to create that security interest have successfully taken place. The relationship is now firmly attached to the physical item. Finally, we reach the concept of perfection. Perfection happens when those invisible strings are locked in securely and permanently, typically by registering the interest in a public database called the Personal Property Registry.
You can kind of think of this step as picking up a giant megaphone and announcing to the whole world, hey, we have a legal claim to this specific asset. Perfection gives the lender the absolute greatest possible bundle of rights to protect themselves against any third-party claims if things ever go south.
Okay, Section 4. Priority, who gets paid? The ultimate trump card.
So let's see how all this legal structuring behaves when things actually go wrong and a business faces bankruptcy or default. The crucial point here is that priority dictates an absolute, unforgiving hierarchy of who recovers their money. First, the collateral property is sold off. Then, the secured party sitting in the very first priority position gets paid in full. Only if there are funds remaining does the party in the second position see a single dime. This structured process just repeats until the funds are completely exhausted. If you're sitting at the bottom of the priority list, you might walk away with absolutely nothing. That is exactly why perfection, which legally secures your spot in line, is so incredibly vital.
But there is a fascinating and really powerful exception to this called the Purchase Money Security Interest, or PMSI. If a lender provides the specific funds to a debtor to acquire a specific piece of equipment, say funding a brand new tractor, they get a PMSI. This is essentially a VIP skip-the-line pass. It grants that specific lender a super priority position over other general creditors, just for that exact piece of equipment. It strongly encourages lenders to finance new equipment, knowing they absolutely won't be pushed to the back of the line behind a business's older debts.
Section 5. Funding farms and clinics. Real-world applications. Now let's look at how these financial tools and legal protections actively apply to Manitoba's vital industries. Because companies operating here, like Falcon Leasing, can perfectly secure their interest using those exact PPSA rules, they can comfortably float massive assets to local businesses. We're talking heavy earth-moving excavators for road construction, life-saving MRI machines for medical clinics, and massive harvesting machinery for agriculture. That rock-solid legal certainty makes this broad, expensive portfolio entirely possible.
And honestly, the sheer scale of this lending is truly staggering. Take the Manitoba Agricultural Services Corporation, MASC, for example. They offer incredibly robust direct loans providing eligible farmers with up to $6.25 million, and that includes up to 80% financing. That is a massive amount of capital that can be deployed to purchase foundational land, essential livestock, or top-tier operational equipment.
But even at that impressive scale, lenders manage their immense risk very carefully. For equipment financing, MASC manages their risk by directly tying repayment terms to the age and expected lifespan of the asset. They'll comfortably offer a maximum repayment term of 10 years for a brand new machine, but if you're buying previously owned equipment, they strictly cap the repayment term at 7 years. It's a highly practical way to balance a borrower's need for time with the lender's need to ensure the physical collateral strictly outlives the loan. Makes perfect sense, right?
And finally, Section 6. Manitoba Government Business Incentives, the extra edge. Beyond standard commercial lending from private entities, we really need to look at how the province itself steps in to actively incentivize growth. The Manitoba government provides an incredibly deep ecosystem of specialized funding aimed at pushing various stages of business development. You've got the Innovation Growth Program to help commercialize completely new products, and the Manitoba Works Capital Incentive, specifically designed to lower the heavy barrier to entry for major capital building projects. Plus, there are powerful funds for export development and trade growth. These aren't just handouts, they're highly strategic investments designed to keep the province's entire commercial sector fiercely competitive.
There are even incredible, highly targeted niche programs like MASC's Young Farmer Rebate. Operating under their Bridging Generations initiative, this program directly subsidizes the next generation of agricultural producers, specifically those aged 18 to 39, by offering a generous rebate of up to 2% on the first $425,000 of principal for the first 5 years of their loan. The province is actively engineering the future of its agricultural sector. It takes that heavy, crushing pressure off early cash flow, setting young producers up to actually succeed and expand. It's a total game changer.
Well, we've covered a remarkable amount of ground today. You now understand the strategic cash flow choice between leasing and buying, the unmatched speed of agile brokers, and the invisible legal superpower of the PPSA that makes multi-million-dollar commercial lending safe and possible. The financial machinery of growth is sitting right there, heavily supported by provincial incentives, just waiting to be utilized. So the only question left is, armed with this comprehensive playbook, what is your next big business move going to be? Thanks so much for joining me on this explainer.